Hello, I'm Sam Meredith. Ahead of the US bank holiday this Friday, we're discussing how the latest non-farm payroll figures are likely to impact the US by talking with Chief Economist from Point72, Dean Maki. So first of all, despite job growth in the US cooling in June to 223,000, the labour market appears to remain in a strong position to keep up with population growth. What is your assessment of the labour market at this stage?
So the labor market has rebounded from some weakness in the spring. For example, back in March, we saw only 119,000 jobs created. That's picked up now to, over the last 3 months, an average of 221,000. So we have seen a clear rebound in job growth. That has led to a continued decline in the unemployment rate. That fell to 5.3% in June, and that's been on a steady decline in recent years. It's fallen 0.8 over the past year, for example. So in my view, we only need about 75 to 100,000 jobs per month to keep the unemployment rate stable. So anything in this 220,000 range is going to keep the unemployment rate falling. So the labor market continues to tighten. The good news for the Fed is that so far, in this report anyway, there doesn't seem to be a lot of wage pressures building. We only saw wage growth at 2% year on year in June. So that's continued to remain relatively tame even as the unemployment rate falls. Eventually, over time, that will pick up as the unemployment rate keeps falling. So there's mixed messages in this report, but the bottom line from my perspective is job growth is strong enough to keep the unemployment rate falling, and over time that will lead to wage growth. We're seeing it in some measures, but not in this report.
With the Fed signalling that they plan to raise interest rates this year, many officials have said that September could be the time that the change is implemented. Growing confidence in US inflation and the job market were key to a potential rate hike though. So are you expectant of a change later in the summer?
I do think the base case should be a rate hike in September. It's not 100% probability, but I do think the odds favor it at this point. And the key reason, in my view, is just the continued decline in the unemployment rate, along with the rebound in the economy that is happening. So we are seeing consumer spending pick up in the second quarter. We're seeing GDP growth pick up, in my view. And we are seeing the labor market job growth pick up, and that is important because the Fed doesn't want to wait until there's clear signals of inflation rising significantly before it starts the process of tightening. As the unemployment rate keeps falling, the Fed knows that over time that will lead to stronger wage growth and higher inflation, so they want to move ahead of that happening so that by the time those are really kicking in, the Fed's getting to a more neutral rate rather than just starting the process. So I do think the Fed will be starting in September, and I think this report, while it's a mixed report, is consistent with that.
One area of potential concern for the US may be the weakness in wage growth, which showed no change. As a leading indicator of consumer inflation, how significant is this to optimism in the economy?
Well, it is important to consumers how fast their incomes are growing. And wage growth the different measures of it are showing quite different trends at this point. The employment cost index, which is favored by the Fed, has risen notably to about 2.5%, while hourly earnings in the employment report are only at 2%. So they're not fully consistent with each other. Wage growth is not a very extremely clean leading indicator of inflation. They often move quite differently over periods of time. But in the Fed's view of the world, and I would tend to agree with this, if you do see wage growth picking up over time, that will be associated with stronger inflation. The lags are quite variable and long, and it's not a straightforward relationship, but I do think that will happen. So right now, there's not enough wage growth to really put a lot of pressure on the Fed to tighten rapidly. And I think that's the good news for example, for equity markets, is the Fed, nothing in this report says the Fed has to tighten rapidly. But I do think that the Fed does believe, and I believe as well, that wage growth will be picking up as the unemployment rate keeps falling.
Thank you, Dean. Be sure to check back with Dugoscopy for more updates throughout the week. Goodbye for now.